Hey guys, stick with me to the end of this video and I'll show you the two stocks I'm avoiding this October. Alright, so first up on the list here is Rigetti, ticker RGTI. It's a quantum computing stock, and I'm sure you're all very familiar with this name. The stock has seen some really large swings, both to the upside and to the downside. And let's dive into why I wouldn't be buying Rigetti. So I think it's best to start with management and see if they have skin in the game and what they think about this stock. To be honest, it's not great. On the left here, this interview was done when Rigetti was trading at the $12 to $13 range in January of this. And back when it was trading at $12 to $13 in January, the CEO is saying we have to tamp down expectations. Not exactly what you want to hear as a shareholder. Fast forward 5 months, and the CEO exercised options to convert 1 million shares on 5/21/2025, immediately selling everything, leaving him with zero shares. I get it. The stock went to a price so far and beyond what the financials are and what maybe because people see the vision and they're not worrying about the fundamentals. And I'm not saying this stock won't have serious implications and can be worth a lot of money right one day. I just think with how far away quantum computing is from being usable and affecting everyone's day-to-day life, now is probably a pretty good time to sell. And I know I'm like the messenger of bad news. I keep just stacking it on here, but I just want to show you what I'm finding in my research. The expiration of the National Quantum Initiative Fund really hurt results here, though there's a chance that Congress renews it, chance that Getty has been directly affected with 30 to 50% of its early revenues coming from the US government. You'll see how that has impacted their LTM period in the financials. When a company like Rigetti constantly loses money, to keep the doors open, a company needs to either intake debt or intake equity. And the route Rigetti decided to take was equity, and they achieved this by doing an at-the-money offering of $350 million, diluting existing shareholders. And if you were to come to me and ask and say, man, I see an amazing opportunity in Rigetti, and I understand the fundamentals aren't here. I understand the revenue isn't here. I'm thematically thinking that quantum is going to be the future, and this company is positioned to fit well within that trend. And I'd be okay. I'd say, I do thematic visionary investing like Palantir or Tesla if you really believe in the management and the execution and what they're going for. My problem is it has just gotten way too expensive. I mean, we're talking about a 1,400 times multiple on revenue. So pretty simply, people pay high multiples when they're expecting significant growth. So what I'm a little confused about looking from the last slide to now is this stock's trading at 13, 1,400 times revenue, implying, we're going to blow off out of the stratosphere here. But, when you look into the financials, what is this? One, two, this is their third straight year of declining revenues, and their biggest decline coming in the LTM because they lost a quantum incentive from the government. I mean, the government, and then furthermore, they're not even profitable. They've never been profitable, and they don't anticipate on being profitable. The CEO is saying to tamp expectations. The CEO sold the stock, and experts in the field are saying we're still 5 to 10 years away before there's material progress being made. Net income and EBITDA aren't the best measures of profitability. It can be distorted, and there's accounting intangible expenses like depreciation. So when you account for these things and look at the cash flow from operations or the free cash flow generated, it gives you a much better picture of, money coming in the door and going out the door and what the net change was. But I'm not going to take you all the way through the free cash flow. You can just see this line from cash flow from operations for the last 6 years has been negative. They've never turned a profit. So I'd just like to take a look at what the recommendations are from analysts who follow and are in the industry. And besides the two outliers of 50 and 35, it seems like everyone has determined the price to be around the $20 range, and it currently trades at 46. So for these reasons, the reasons in my other slides, Rigetti's too expensive for me. It doesn't mean I don't think the stock can be valuable one day. It's just right now At this price, it's unattractive, and especially when combined with the financials and the actions you see the CEO has taken with selling his stock. The next stock I'm avoiding on my list is Nike, and let's hop right into it. I posted Nike's all-time chart here to the left just for you to see the big dip, but I'm just going to go into why I feel like Nike's in this problem. Basically, going back a couple years when the new CEO came, he kind of just ran this into the ground, in my opinion. His strategy sounded great on paper, but the execution was poor, and let me explain that. They had this idea that we were going to pull out of the brick and mortar store, cut out the middleman, and let's start direct to consumer and online shopping only. And they thought that this was the way to go. And when it sounds on paper, it doesn't sound that bad. But when Nike pulled out of these stores, it created this, out of sight, out of mind effect, while, allowing these other brands like On Cloud and Hoka to take up floor spaces in stores they likely otherwise would have never had access to. And Nike realizes that this was a big mistake. And since they've been trying to reverse the course and make the brick and mortar stores be, a core part of their focus again. They've already returned to Macy's and DSW after briefly leaving both of them. And there are other stores they left that they could return to as J.C. Penney. But I think they're starting to realize the damage that's been done. This out of sight, out of mind effect, taking the shoes out of the brick and mortar stores, these other brands are eating their lunch. And they're not the best either anyway in comfort. If you there's Hoka, Asics, NB, they eat them all alive. Running, there's On Running, Brooks, and Adidas. Hiking, there's Salomon, Merrell, work shoes, Keen, Blundstone, Timberland, and Nike's falling out of favor. So a lot of people were looking to their most recent earnings call, and everyone, we're gonna beat earnings, we're gonna beat guidance. Big deal, bite me. I mean, they always look this up. They always give extremely conservative guidance that they can beat. Always. Trust me on this. So it really is not impressive. Uh, and to be honest, let's just review. Earnings per share are down 30% year over year. Revenue's up 1% year over year. Yes, the earnings per share is up 250% quarter over quarter. Revenues, up 6%. They beat earnings per share by 81%, revenue by 7%. It wasn't enough for me to see the turnaround and then hit that inflection point and say, Nike's back. I still don't see it, and I'm waiting for more. And if you just take a look, I got the income statement here for Nike, and the revenue's been very lackluster. I mean, almost since 2022, 4 years, they haven't changed revenue at all. When you go down to net income, they're at a 6-year low. Not exactly what you want to see in the turnaround here. And here's Nike's balance sheet. Not too much to talk about, just noticing the trends here in cash being at a 6-year low from 99 to 7 billion, and their long-term debt is high at 8 billion, but you can see that they've been continuously paying it down, but it's pretty on par with cash. So not the greatest balance sheet, not the worst. So why this makes me a little worried about the debt is because the company's not generating nearly what they want in cash flow from operations after they invest and put down, their financing on the total debt repayments here. They're significantly changing cash is minus 2 billion, minus 1.5 billion. They're not going to be able to continue or have much cash available for operations when they continue paying down this debt like that. They need to turn the corner very soon. So if you remember back to Nike's income statement, they pretty much stayed flat for the last 5 years. And yes, they do turn a profit, but their profit's at their lowest point in 5 years. So taking a look to some of their metrics for a company that's hardly been able to grow over the last 5 years, trading at a 36 and a half times earnings multiple, I don't think they deserve that. That's a high growth stock. That especially for shoes. I mean, 36 times multiple is very expensive for someone who's made no progress in 5 years. All right, that's it. That's all I have for you guys. Let me know what you think. Or would you buy Nike or Rigetti, or are you hiding from it like me this October? You take care, and hopefully you learn something, guys. See you next time.